Hello, everybody, and happy Monday. Today we're going to go into banking, but not banking here in the United States directly, but we're going to start overseas in Japan. Look at this headline. So you've got Japan's Norinchukin, by the way, they just call it Nochu for short. They're gonna dump $63 billion worth of US and European bonds. All right, I mean, $63 billion in today's economy is like nothing. So why is this such a big deal? Well, this bank showed up on our Federal Reserve's preferred bank list last fall. And everyone said, why is Nochu showing up on the Fed's preferred list to get money, to get swaps? Why is this mid-range Japanese bank? It's only an $800 billion bank. It's not like JP Morgan or Goldman Sachs or Bank of Japan. It's a little bank by today's standards. Why are they on the Fed's list? The thinking here is they're in deep trouble. And it isn't just this $63 billion they're trying to free up, but it's their derivatives. So I'm going to take you back in time a little bit. Let's go back to 2007, 2008. So we start to have problems in late 07, early 08. If you remember, Bear Stearns goes down, AIG goes down, Century goes down. And this is when Ben Bernanke, chairman of the Federal Reserve back then, said, don't worry, we have the problem contained. His famous containment speech. Well, it wasn't contained. And come September, Lehman went down. Lehman was a $400 billion bank. So good-sized bank, but again, not Goldman Sachs or Bank of America. And yet it took $4.5 trillion here in the United States to plug a $400 billion bank hole. What was going on there? Oh, it was the derivatives. What's a derivative? A derivative is an investment that derives its value from something else. And without going into too much detail on it, think of it as a bet. You can bet on interest rates. You can bet on oil prices. You can bet on cattle prices. You can bet on anything on Wall Street. And it's really just air. Now, it does derive its value from something else, like a real cow or real oil, but it's really just a bet. Well, Lehman had massive bets in the trillions. So not only did they have to plug the $400 billion hole, but they had to plug their bets. And by the way, the $4.5 trillion that we had to fix just in the US, it was $22 trillion globally to fix that mess back then. So why does this matter? Apparently they have massive derivatives exposure. And the Federal Reserve believes it's enough that they needed to add them to their preferred list to prevent a daisy chain of events from occurring in our banking system. By the way, the $63 billion, don't think they're able to sell $63 billion worth of stuff for $63 billion. Because a lot of these bonds, they bought when interest rates were 2%, 3%. Well, now they're 5 and 6%. So they're going to the market with $63 billion worth of 2%ers. You go to the market, who wants to buy a 2% bond? Nobody. The rates are 5. So they have to discount it. They're not going to get $63 billion for what they're selling. All they're trying to do is get some cash to live to fight another day, but don't think their problems are solved. So what am I saying? There are problems in the banking system, not just here in the US, not just in Japan, not just in China. They're all interconnected. And by the way, if you think they're alone, I pulled this chart up. This is from 2019. Look at the names on this. This is trillions of dollars going to Japanese banks. Well, wait a minute. Why is the US backing this up? For the same reason they had to do it for Nochu. So where do you go with this? They're going to have to do what they did back in 2007, 2008 at some point to plug the holes in the banking system. They're not going to let the system fail. They're going to print a bunch of money. So buckle up. This is what's coming. It's systemic risk right now. And actually, I'll be doing a series on this. We'll go into it into more detail next week. And with that, I'll turn it over to Walt.